Welcome to part 2 of the course on strategy and optimization. So the first thing we covered in the previous video was that you have to judge the sentiment of the market. So there's a saying called the trend is your friend, and this is very true in the stock markets. And there's also another saying that a rising tide lifts all boats, and this is very true in the markets. So when we say the trend is your friend, what I have here, let me show you. I've got 4 charts here. The bottom right one is the SPX. That is the S&P 500 index. And this is a 1-year chart of the SPX. And we can see that we had a dip last fall around July, August, September. And then since then, from October onwards, it's been on a nice move up. And I also have 3 other stocks here. This is Apple on the top right, Priceline on the top left, and Google on the bottom left. Now, you're always going to see a little bit of inconsistencies from stock to stock. But you can see that even though Google has had some challenges with earnings, you can still see that even in Google, which is probably the least correlated among all 3 of these stocks to the S&P 500 index, you can still see that the graph has gone from a low of about 468 and it touched a high of about 670. And the S&P 500 index from last October onwards, it's been on a steady climb upwards. Apple, of course, has been on a similar climb upwards, but you can still see the correlation. Even when the S&P was down in its worst time in the last 1 year, Apple has just been doing nothing at that time. So granted, it may not have gone down like the S&P, but it did not go up either. It was just sort of flat. But since October, you can see very clearly that even Apple is on an upward graph. Similarly, for Priceline, you can see that it's been flat for the last fall, just when the S&P was also hitting its low for the last 1 year. Priceline also hit its low around the same time. Then since then, it's been on an upward graph. So I just took these 3 stocks as examples, and you can pretty much take any S&P 500 stock and you'll see that about 70 to 80% of S&P stocks are correlated quite strongly to the S&P index. And that's what exactly beta measures. Beta measures the correlation of a stock to the S&P 500 index. Within the S&P 500 index, there are a few stocks and a few sectors that are called counter-cyclical sectors or counter-cyclical stocks. Those counter-cyclical stocks or sectors, they tend to do well when the S&P is doing badly. So a couple of examples are consumer staples. Then you have utilities. These are some kinds of sectors which tend to do well when the S&P is doing badly. So when the S&P is doing badly, generally the mood is quite sour and people don't spend that much. So if that's the case, then technology stocks, financial stocks, these all get hurt. And the counter-cyclical stocks like consumer staples and utilities and some other like maybe pharma, they're generally counter-cyclical. So they tend to do quite well, or at least they tend to not take a beating like the S&P 500 does. You can always look at the beta of a stock and you can have a pretty good idea of how that stock will perform in relation to the S&P. And you can do that for sectors as well. So you do have sector ETFs that, for example, the XLF is the financial sector ETF. These kind of sectors also have a beta correlation. So if you wanted to look at a beta correlation of an entire sector, you could go to the ETF of that sector and then look at its beta. And that will tell you how that entire sector is correlated to the S&P 500. But in general, about 70% of stocks in the S&P 500 are well correlated with the S&P. So if the S&P is going up or down, you can expect all of these stocks to perform in a similar manner. So understanding where the S&P or the broader market indexes are going or where it has the potential to go is very important. And this is where the big picture aspect of understanding financial markets comes into play. To understand where the S&P 500 is going, now you have to look at all the factors that affect the S&P 500 itself. And those factors could be anything in the world. Those factors could be global. They could be a Europe crisis, they could be a tsunami or an earthquake, and they could be geopolitical factors. So any of that can impact the S&P 500. But if you look at the S&P 500 and you determine that the S&P 500 is on a trend, like for example right now in the past 3-4 months, especially since November, December of 2011, the S&P has been on a nice trend. But as we can see right now in the last few weeks, couple of weeks or 3-4 weeks, we've been seeing a little choppiness in the S&P. So again, this kind of a correction is very normal. But if you look at these last 4 bars, the correction started right here in the first week of April. It went down. It's trying to recover. Looks like last week it did put in some sort of a recovery. And now it's above its simple moving average. So this tells you that, this kind of a correction, a 5 to 10% correction, that is normal. And that's normal in the market cycle. So again, it looks like the S&P is just above its moving average. So you should generally see all the stocks that are correlated to the S&P also try to do the same. So Google is still reeling from its earnings announcement, although it seemed like a very good earnings report. Priceline is already above its 9-period moving average. It dipped only slightly below it. Apple seems to have dipped slightly below it, but if the S&P continues to go up, you'll see Apple also rise above its 9-period moving average. So in general, we have to look at the sentiment because there's no point in taking a short trade when the market is on an upswing. And similarly, if the market is on a downward swing, there's no point in taking a long trade. You're going against the grain. You're swimming against the tide, and you don't want to do that. So looking at various things, we can also look at volume, we can also look at price action, but you need to determine what is the current trend. And since we are looking at a swing trading opportunity, which is anywhere from 2 weeks to about 8 weeks, the current trend is very important. You could have gone long anywhere on any of these weeks here in the last 3 or 4 weeks of December, because you knew that the downtrend was changing direction. And perhaps even as late as the first week of January or the second week of January, you could have gone long because it's clearly telling you that the trend is changing. So somewhere here, if you had gone long, you would still be riding a nice trade. And perhaps you would have gotten off here and then tried to get back long after a couple of weeks into the S&P. You could do that you could follow the same kind of a pattern for all the stocks as well. So it's very important to follow what the current trend is, and the best way to do that is to follow the S&P 500 index itself. And once you determine the trend for the S&P 500 index, then you can take your position in any particular stock or an ETF and ride with that wave and not against it.